Welcome back to Clear Skies Retirement with Jay Kirkwood at Secure Financial Management. My name is Randy Cook. We're here each week to talk through some of the questions you probably have about your 401k, and you're looking at your accounts right now and you're looking at markets and you're like, oh my gosh, how long did it take me to spend that money? And look how fast it went away. Oh my gosh. Yeah, there's a lot going on right now, and this is the time when you really need a financial advisor in your life. And we would like to introduce you to Jay Kirkwood. How are you doing today?
I'm doing great, Randy. How about you?
I'm good. And I think that over the last couple of weeks, we've been doing our very best to give people some answers, some direction, some ideas and things to do. And one of the things that I know you and I have talked about is somebody will look at what's going on right now and say, Jay, bring me the cash. Get me out of this. Get me out. Jane, get me off this crazy thing, like the old Jetsons cartoon. So I was looking at an article, and it was a picture of all the billionaires that we all know. There was a Bezos and an Elon Musk and Warren Buffett and all these guys. And the question was, what do these guys do during times like this to save themselves from losing so much money? And one of the answers was they buy art. They buy things outside the market. And I'm saying, well, that's very helpful. If I had enough money to buy a Picasso, I would not be talking to Jay right now. I'm not an art connoisseur. I don't think that that's for the regular public. Sure. But the idea, though, the idea that you've got money in the market and then you've got something outside the market that's not affected, that is a concept I think that we could probably explore here. So what I mean, you know, you'll talk to somebody who bought a condo and they're getting rent from that. That's an outside income, outside the market. So how much of that do you do with your clients? How much money is in the market? How much money is out of the market? How much of these kind of things do people look into it and become a part of their retirement income?
Yeah, it's a great question to bring up at this time. And, you know, the high level question is, well, it depends on what the person's situation is. But the important element I think we're discussing here is that probably everything that you have should not be invested in the markets. Okay. If you're 30, if you're 40, if you're 20 years away from retirement plus, maybe you could do that. But the people we talk to, that's not where they should be or where they want to be. And the reason people struggle so hard with this concept is they're like, well, then what do I do? All I know is investing in the markets. I was in my 401k for decades and just, I kept investing and it just worked out. But they realize that when they come from work life into retirement life, things are changing completely, right? Before that, it was contribute to my 401k, growth. I had a paycheck coming in and I just knew that was coming in every couple of weeks. What's changing now? Pretty much everything. Do I want some growth in my portfolio? Yeah, but I can't stick my neck out there too much because I need to use this for the rest of my life. And it'd be great if I could have a little bit of income with it as well and some growth. I think I mentioned that. And also now I don't have a paycheck coming in anymore. I need to find a way that I can recreate that with these assets that I've saved. Focusing just on the markets to achieve that goal, I think you're going to find that a pretty tough road.
And so we've got to discover some other places where our income is going to come from. And a lot of us don't know what to do because we know stocks and bonds, and that's all we know. So a lot of time, the reason we call this show Clear Skies Retirement is because Jay is a pilot. And Jay, one of the things we talk about is before you go into the cockpit, before you do your flight, you got to have a flight plan. And in that flight plan, if you're going from here to Shreveport, and there's got to be, I would assume, an exit plan. If something goes wrong, there's got to be some alternate airports that you could land at so that you could safely get out of the storm, so to speak.
Yep.
Do we do that, and can we do that financially speaking and say that we've got to have an exit plan if something like this takes place?
Yeah, so when you mentioned the flight plan side of it, that's probably the most boring part of the flying trip, but the most important. Okay, obviously our aircraft having enough fuel, oil, all that sort of stuff is important, but it's a great correlation because we always talk about how we start with planning, right? And that's not really that attractive to a lot of people. It's just like, that sounds boring. It sounds like it's quite a bit of work on my part, and just invest the money. Well, if someone comes to us like that, we're like, hey, we can't work with you because we know how important the planning is, okay? This is why. Let me give you an example of it. Actually, something happened to me. I wasn't flying to Shreveport. I was flying up to Dallas, okay? And I had a flight plan, and you mentioned an alternate airport, okay? So I was not required to have an alternate airport on this flight. It was what we call VFR conditions, right? Beautiful, almost unlimited visibility, no bad weather whatsoever. So in a case like that, you don't need to have an alternate airport because they're like, well, what could go wrong, right? You should be able to just go to that airport and land. Even if I don't need an alternate, I always just have one. Even if I don't file it, I've got it there in my back pocket saying, if this one doesn't work out, there's actually an airport up there called Lancaster Airport. It's on the southwest side of Dallas. There's a ton of airports up in Dallas. That's just the easiest one for me. Simple, no control tower, easy to get in and out of. And I was like, well, I'm going to go there. In my back pocket, not thinking I would need it, my alternate airport was Dallas Executive, which you can almost see from Lancaster Airport as soon as you take off. That's how close it is. But just saying, well, I'm going to go there, it's more complicated. That's a towered airport. I can't just fly in there. I've got to talk to the approach controller, which means I need a frequency for them, right? I need to know what the identifier for the airport is. I need to know what the field elevation is. I need to know what the frequency is for the tower. And what you don't want to do is you don't want to be in the air having an emergency or needing to use that alternate and then fumbling around the cockpit trying to find all this information. You want to have it there ready to go right away. And what happened in this moment is I got to Lancaster and the runway was closed.
Uh-oh.
Okay. So there was a plane that had blown a tire on the runway and you couldn't land. No one could land. No one could take off. And we stayed in what's called the traffic pattern. It's basically circling the airport for about 15 minutes. And there wasn't a whole lot happening down there. The plane was still stuck there. I was like, okay, great. Boom, we're activating the alternate, and we're on the ground at Dallas Executive in 5 minutes.
Got it.
If I had not done the planning, if I didn't have an alternate, would it have worked out? Probably I would have figured it out. It would have been pretty ugly. It would have been pretty messy. And I would have been uncomfortable being in that position. It's the same with the planning. It's the same with the financial side of planning, is that when something like the market volatility we're experiencing now, do you want to be fumbling around saying, well, let me figure out an alternate plan and I'll try and land this thing and not have too much damage to my portfolio? I don't want to invest like that. I don't know about you.
Yeah, this is the time when I feel like we're all fumbling around the cockpit. Mm-hmm. We don't know what to do. Mm-hmm. And so now imagine yourself in retirement. I don't know what to do. Now you're trying to find your first financial advisor and you're trying to literally get yourself out of a fix. I mean, this is classic. This is me and my lawnmower is broken and I try to go in there and fix it and I come out with a bunch of oily parts and I bring it to the guy and go, can you fix this? And he goes, love you, buddy. Yeah. And now I'm in for a big bill. So that's not where we want to be, not where we want to be at all. That's why we talk about every day on this show is to sit down with Jay and get an evaluation of where you are right now. And do you have an exit plan? If we go through this again, do you want to be fumbling around like we talking about? Give us a call. Let's put a solid plan together that has these things built in. 210-985-6200 is our number. 210-985-6200, or our website is retire210.com. And when you get there, right at the top of the page, there's a button that says schedule a meeting. You can click that. Now you'll be on your way. You go down to the bottom of the page and you can fill in some information there, get a free copy of Jay's book, and then we'll reach out to you that way. Or you can call us again. 210-985-6200. Well, you talk about having a plan, Jay. And having a plan for times like this is one thing. Mm-hmm. Having a plan for your spending is also just as vital. According to this study I'm looking at from Schroders, says 53% of retirees don't have a spending plan. They just take money from their accounts as they need it. And when your account's going down, that's a double whammy. And
That's
that
right.
becomes a real problem. So talk to me about building income, but not just from our 401k or whatever. It's guaranteed income that comes in. That bucket gets filled up every month. It's not just peeling money off the top.
Yeah, so 53% sounds low to me, frankly.
Wow.
Because a lot of people that we meet with before we start working with them, I'll ask them, hey, what are you spending a month? I don't know. Well, that's probably our first area we need to work on, so we know what are we dealing with. And it's interesting when people go through the process that it's like, I'm spending how much eating out? I was like, yeah, it's a bit of an eye-opener, isn't it, right? but what you said is exactly right. The people that are getting hurt the most in this market downturn are those that are having to sell while the market is down to keep funding their retirement.
Got it.
You mentioned double whammy. Like, am I spending some of my assets that I save for retirement? Yep. Am I having to spend those assets while the market is also depressed? Yep. That's the second negative you've got there. A real problem. And look, I've seen this derail retirements, right? We've had people that have come to us and over the years, and they say, well, I wasn't invested the right way. I retired. I thought it would be all right. I just kind of spent whatever I want. And I got to tell you, I'm back at Home Depot now. I'm working there part-time because we didn't do this right the first time.
That is not what you want in your retirement years. You know, if you need $40,000 a year for retirement and the market just took 100 and now you took your 40 that you needed, now you're down, instead of 40,000, you're down 140,000. And that's what really starts to cause the panic and people running out of money. Give us a call. Let's build a plan, not just a tax plan, but an investment plan, but an income plan for you as well. Here's our number, 210-985-6200, 210-985-6200, or retire210.com. Find us right there on the website. There's a button that says schedule a meeting. You can also find our podcast. We have a podcast on iTunes and Spotify and probably your favorite podcast provider. You can listen to this show and many others. All you have to do is look up Clear Skies Retirement, and we'll be right there for you. Well, we've learned a new word this year. That word is Doge, the Elon Musk effort to get rid of government waste and efficiency. So whether you agree with it or not, I thought we would take the word Doge and apply it to our retirement plan. Because, Jay, one of the things that you do is you do an analysis for somebody is to figure out what's working and what's not working. I don't want waste and inefficiency in my government. I also don't want it in my retirement plan. So what would you consider to be some of the consistent things that you find that might be not working or wasteful and inefficient in a retirement plan?
Yeah. So I think we can talk about this in two different kind of topics. Is the actual spending / budget, right, in a retirement plan, and then also the investment allocation side in a plan. Okay. So very often when we're going through one of our first meetings with clients is we're going to say, hey, what do we need for retirement funding? Some people have no clue. Some people have done a lot of work. And it's a bit of a budget discussion, right? And I know that's a dirty word for some people, but change it. Call it a spending plan, whatever you want. But we've got to get this done, okay? And we'll go through and we'll find things that just, they're not necessary. Or it's money that's kind of just being wasted. And we had a couple that were in here, it's probably a month ago, and they're members of a country club. And it's not cheap doing that. And I said, hey, if this is important to you, right, if it's something you guys do a lot of, you're very involved with that country club, let's try and find a way to keep this in the budget, in the plan. And they're like, I can't remember the last time we went there. And it just got on, it's, not so much magazine subscriptions, but, back in the day, magazine subscriptions, and you're like, wow, I'm spending how much on these magazines? And I haven't even read them in a while. So it's going through. Family members can sometimes be a drain on the budget, whether it's adult children or other family members you're helping out. Is there a discussion needed to say, hey, this was okay while I was working. now I'm going into retirement. I've really got to take care of myself, right? So it's cleaning up that side of, I'll call it the balance sheet, okay? The next side is, what are our investments doing and how are they working for us? A big thing we're focusing on right now is we're looking at people that got into annuities years ago, and they're finding that they're in an annuity that's paying them 1%, 2%, because they did this back in the 2019, 2020 sort of period, 2021 period where interest rates were incredibly low, or they're in old bonds that are not paying them much. And we're saying, hey, you've got an opportunity to upgrade here. Let's not let this drag your plan down. Let's not let this be an inefficient component of your investing, and get these things upgraded.
Yeah, it's kind of like refinancing your mortgage.
That's right.
When rates go down, you refinance your mortgage. When rates go up, you could refinance your annuity. That only makes sense, right?
Yeah, absolutely right.
All right. So as we talk about inefficiencies, one of the things that I thought maybe we would touch on is the discovery of the fees that are inside your portfolio. Yeah. I mean, the people from Fidelity and Vanguard, they're good people, but they don't work for free. And a lot of us, since we're not writing a check every month for that service, we don't even think that we are paying for that. And sometimes it can be an eye-opener, especially if you have an advisor and you come in for a second opinion. You'll start to learn what you're spending on these things. And sometimes that can be a little maddening, can it?
Yeah, it can. And, I had a call actually with a lady who was a referral from one of our existing clients. She's up in Fort Worth. So we just did a virtual meeting, and we were chatting, and she's like, I recently lost my husband. He used to take care of all this, and I'm kind of trying to muddle my way through this and figure it out. And she said, part of our money is at Schwab. And I said, okay. And she's like, there's some guy there that calls me every now and then and tries to, recommend something to me. And she said, his thing was that they don't charge me, but I've noticed all of my investments are only in Schwab type products. Okay. I was like, it doesn't take a rocket scientist to figure that one out, does it? And so that's the thing, is there's an old saying, I'm probably going to get this wrong, is that if you don't know where the cost or the fee is coming from, you are the product. Right. That's what's happening. Right. It's the same whether it's 401ks or whatever it is. But yeah, you're absolutely right. Analyze and maybe it's a fine investment allocation to have all the same products like she has with. I don't know. We haven't gotten a deep dive into the portfolio yet. Maybe it's okay, but I've got to wonder if you've got a portfolio that's all concentrated in one firm's product. Is that the best option for you, or is it the best option for them?
Good point. Yeah. Well, that's one of the ideas that we have when we sit down and do the analysis is figure out what's working, what's not working, and then maybe open your eyes to what you're paying for and some of the things that does everything you have a purpose, or did somebody say you should have this in there and you don't know why? Right. Yeah, there's a lot that can come out of an analysis, and we would love to do that for you at no charge. Give us a look on our website, which is retire210.com. If you see up at the top of the page, says schedule a meeting, you do that. That's no charge. You go down to the bottom of the page. You can fill in some information there about you and what you're concerned about. It will get you a copy of Jay's book as well and get a date on a calendar. Let's do that analysis and figure out what's going on inside your retirement money. Again, 210-985-60-200. Well, there was a guy back in the 90s. His name is William Benjamin, and he created something called the 4% rule. The idea was if the market averages 8-9% and you take 4% of your money every year, you'll never run out of money. Makes total sense, I guess. But what if the market doesn't go up like that? That's the little caveat there, right? So we talk about decreasing your risk as you go into retirement. William Benjamin is still around, and he just recently said he believes you should increase your risk in retirement.
Yeah, there are three choices: reduce stocks, maintain them, or increase them. And of the three, the worst is to decrease your stocks. It's the one thing you don't want to do. Fortunately, there's a plateau between about 47% stocks, about 75% stock. If you stay in that range and the rest in bonds and cash, you'll end up with about the same withdrawal rate, about 4.7% or whatever you choose.
that goes against all of today's conventional wisdom. I mean, that's exactly opposite of what I hear from you and from everybody else. He says you should increase your risk because you need that growth.
Yeah.
People are hearing stuff like this. How do we figure this out?
Yeah. So the problem with stuff like this, with recommendations like this, is that what they're saying is not wrong, but they're not taking into consideration the human element. What we really do when we're invested. Because you mentioned, hey, average is 9%, take out 4%, and then you've got some growths there still to take care of inflation and stuff. Well, that's assuming that you have 100% allocation to the stock market, which means in times like this, you have 100% of the downside participation and you're down 15, 20%. Your $1 million is down to whatever, 850, 800,000. The first problem with that is most people cannot stomach that volatility. Okay. So we are really going into like a mental sort of emotional sort of discussion, I guess you can get with this. If you just write it out, historically, if history will repeat itself, right? He's accurate. People cannot do that. And these sorts of events prove that they cannot. My phone wouldn't be getting blown up. I wouldn't be constantly in client meetings kind of discussing what's going on with the portfolio if people were 100% okay with risk. It's not realistic for what he's discussing there.
Well, there is a delicate balance that we all have to figure out, because you say, if you're a young person, you should have more in the stock market.
Right.
If you're an older person, you should have less in the stock market. That only makes sense. But then we turn around and say, hey, you could be in retirement for 25 years. So are you really a short-term investor? I get that, but maybe we put our money in different places that isn't as at risk as we did when we were in our 20s and 30s.
You really need to, because what we always talk about is once you get to retirement, you've lost one of the most important assets you used to have for investing, and it's something called time. Okay, you've lost the element of time, because in this scenario, one of the bigger risks that you face is what's called sequence of returns. Okay, and we talk about sequence of returns. We say, well, if we look at a 20, 25, 30-year time period, and we've got the market going up most of the time, which it does, but there's some big down years. I don't have the calendar in front of me, but I think it was 2001 and 2002 were back-to-back down years. 2008, 2009 were ugly. 22, et cetera, right? This year, perhaps, who knows? If you retired at the beginning of 2021 and you were 100% invested in the markets and your portfolio goes down, and I can't remember what the drawdown was, but 20%. And you think, well, all right, bad luck, next year it'll go, and boom, it's down another 15% the next year. You're probably never going to recover from that.
Right. Yep.
Because you were 100% in the markets. Where's your income coming from? Oh, the stuff that's very, very much down in my portfolio, I'm having to sell it so I can finance my retirement. You will probably never recover from it. And it's a small risk, right? The likelihood that you retire into a market that goes down as soon as you retire, we have a back-to-back down year. It's small, but it's not a risk I want to accept for my retirement.
And that's where we're all thinking right now. That's where our head is right now. I don't want to have one of these years happen in my retirement years. And so we want to put a plan in place to hedge that off and have a plan for it. That's the idea behind sitting down with Jay and building that kind of a retirement plan. Give us a call. We'll do that for you at no charge. We'll sit down with you and give you the analysis of where you're at right now and some suggestions on how you might be able to improve. Give us a call. Give us a look on our website. It's retire210.com. At the top of the page, it says schedule a meeting. Click on that, or go down to the bottom of the page. There's a form fill right there. Get a copy of Jay's book, or you can just give us a call, 210-985-6200. 210-985-6200. We thank you so much for listening today. And remember to have this podcast delivered straight to your favorite podcast platform by hitting like, follow, or the subscribe button. Thanks again for listening to Clear Skies Retirement, and we'll see you next time.
Investment advisory services offered through investment advisory representatives at Secure Financial Management, a registered investment advisor. Exposure to ideas and financial vehicles discussed are not designed nor intended to be applicable to any person's individual circumstances. It should not be considered as investment advice, nor does it constitute a recommendation that anyone engage in or refrain from a particular course of action. Past performance is not a guarantee of future results. Investments can fluctuate, and when redeemed may be worth more or less than when originally invested. Financial professionals are not licensed in all 50 states. To find out if Secure Financial Management is licensed in your state, please contact their office. Secure Financial Management is not affiliated with nor endorsed by the Social Security Administration or any other government agency. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Wholesalers Insurance. Jamin J. Kirkwood, Texas Insurance License number 1421850.